Hello. This video is to explain a bit more of the cerebral side of where upleft came from as a concept and as a word. Now, I'll warn you, we're going to go pretty deep here. There's going to be charts and graphs and numbers. So if that's not your cup of tea, you might want to go back and watch one of the other videos now. But if you'd like to learn a little bit more about the day-to-day activities we take to maximize benefit at upleft, stay with me and you might even learn something. Everybody is looking for a greater return. All things being equal, we'd rather make more money than less. So as we set up this chart, we're going to put return on the vertical axis, and we're going to put risk on the horizontal axis. What we're saying here is the higher up on this chart you are, the greater your return. The more to the right on this chart you are, the greater your risk. Now, ideally, you'd want to be where this star is, which is to say, your risk is very low, your return is very high. Now, that's an ideal. It's not necessarily realistic for all investors, or for any investors for that matter. But let's see how close we can get. Now, risk, for the sake of this conversation, is going to be measured by standard deviation. Essentially, this is a measure of how much you can expect your portfolio to go up and down, and to what extent. It's commonly used in financial services as a measure of risk. Now, today is not the day for me to discuss how appropriate that might be, but again, for the sake of this conversation, let's just call standard deviation your risk level. If you start with a portfolio in the upper right of this chart, what we're saying is the return expectation would be high, but you would also expect to go through quite a bit of ups and downs to get there over time. Higher risk, higher return. This may be a portfolio that's 100% stocks. In the lower left-hand corner of the chart, there's now a diamond that shows where a portfolio might fit on this chart if it's got a great deal of bonds in the portfolio and very little stock. Now, if you adjust up or down how much stocks and bonds you put in a portfolio, perhaps a 50-50 split would look somewhere like this in the middle. And on by moving up and down the amount of stocks and bonds you have in a portfolio, you'll make a pretty much straight line going from the lower left to the upper right. If we connect those dots, we make what economist Harry Markowitz called the efficient frontier. Now, you may ask why there's a little tail here on the bottom where suddenly your return goes down and your risk goes up. Interestingly enough, Markowitz discovered that if you had a portfolio of 100% bonds, you're actually taking a little bit more risk for less return. Again, this is the efficient frontier, named by Harry Markowitz. He won a Nobel Prize in economics. I'll include a link to some more information you can find on Mr. Markowitz's work in the notes for this video. There'll also be a little more information at the end. While the efficient frontier makes sense, it doesn't really solve our problem of getting any closer to that ideal we discussed earlier. After all, a line that goes from the lower left to the upper right doesn't necessarily help us get closer to that top left-hand corner that we're hoping for. But what if we can move you just a little bit upwards of this line? That would be an improvement. So for this conversation, if your portfolio lies somewhere in the middle of this efficient frontier, let's say through this line here, that is the level of risk that you're willing to accept. Now that means that you're going to receive this level of return. However, we're not getting any closer to that star. But if we just scoot it up a bit, now what you're seeing is you're getting a little more return for the same level of risk. Well, how can we get more return? Simply enough, we can lower your costs. Through any efforts we might take to reduce the investment costs involved in your portfolio, now the amount of money you actually take home is more than it would have been otherwise. That's after costs. In doing so, your true return, the spendable money you've got at the end of your day, will have gone up. Now, from this portfolio, where you've got a little more return for the same level of risk, you can say, well, what if I added some more bonds to that portfolio? Well, if you added bonds to that portfolio, you'd slide down sort of your own imaginary line here until you would end up in a portfolio that's actually got the same level of return for a lower level of risk. So now you can do this according to your priorities. You can say, well, it's more important to me to have greater return for the same level of risk, or I need a certain level of return, and I'd rather get there with the least amount of risk possible. So similarly, by taking any one of these dots along the line and reducing the costs, you've essentially made an entirely new line of higher return portfolios at the same level of risk. And here's the outline. So now again, for this level of risk, you've got a greater return, or for this level of return, you've got a lower risk. Now let's go back to this example where you kept your risk level where it was, but by reducing costs, you took home a little bit of extra money. Well, what if from here, we could take your portfolio and shift it a little bit to the left? By shifting to the left, I mean, we're reducing the risk of the portfolio. Now, how can we do that? In this case, we have a rebalancing discipline. I'll get into the details of what that means on a separate presentation. But for now, understand that our quarterly rebalancing discipline does help to reduce standard deviation of a portfolio over time, helps to reduce that measure of risk. So now you've gone up in the chart by reducing cost. You've gone left on the chart by instituting our rebalancing discipline. You could go up yet again by having more take-home money through proper tax management. You could go up again, which is to say, eventually you could spend more money over the course of your life by having an intelligent spending strategy that Upleft can help you with. You can reduce your risk by having a proper asset allocation, greater diversification in the portfolio. Again, all of these topics we can address in a future presentation or future presentations. But for now, let's just understand the concept here. These are activities we take in portfolio construction and in the ongoing management of your investments to keep taking this original portfolio we had set and move it up to the left, up to the left. Every time, either increasing your expected return or decreasing your anticipated level of risk. Lastly, this takes a little bit more explaining, but we can increase your expected level of return through correcting something called the behavior gap. Now, this is a concept made popular by a gentleman named Carl Richards. He wrote a book on the topic, in fact, and his work is based on something that we refer to as the Dalbar study in the industry. What the Dalbar study says is that the average investor actually takes home substantially less than the average investment portfolio. The reason for this is our own behavior. Essentially, it's our inability to sit still and let the markets and our investments do their work. Instead, we intervene. We buy at wrong times, we sell at wrong times, we make emotional decisions, and these things all together turn into this behavior gap. Once again, I'll include a link to some research in the notes for this video, as well as in a later slide that you can view. But the key is this. Throughout these processes, we have taken this original portfolio, and now through a series of pretty small moves, we have made a rather substantial move up and to the left. Keep in mind, this chart is really only to explain a concept, not to any specific scale or any specific dollar amount or percentage. The point being this: a move up and to the left is the investor benefit that we provide to you. Once again, when we build portfolios, as we manage portfolios, even as you spend down a portfolio, all day, every day, we're making moves to make your experience better, to get you closer to that ideal position in the up left corner of the chart. Again, if you want to look at some additional resources on some of the things we discussed, you're welcome to jot these down or look for the official links somewhere in the information for this video. Thanks very much for spending a few minutes. The attorneys would love it if you took some time to read these disclaimers. And we look forward to seeing you next time.